These are Nebraska corn farmers. They work in acres, not hours, harvesting the energy and climate solutions the world needs. We are proud to stand with you.
The success of tomorrow's soy industry depends on the actions we take today. The future is here, and the time to move is now.
Market Journal Television for Agricultural Business Decisions is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources in partnership with the Nebraska Rural Radio Association. Promotional support provided by the Nebraska Farmer Magazine and partial funding provided by the Nebraska Soybean Board and the Nebraska Corn Board.
Hi everyone, I'm Bryce Duskett, and thank you very much for joining us today on Market Journal. Happy holidays to you and your family. This week we're bringing you a special marketing segment from this year's Nebraska Ag Expo. My colleague from the Rural Radio Network, Chad Moyer, sat down with a pair of well-respected market analysts to get their take on 2024 and preview what could be ahead for 2025.
Good to have you guys on the panel. Thanks for agreeing to do this with us here today. Let's just start by kind of taking a half a step or a step back and just kind of remind ourselves where we're at. We'll start with you, Darren. Just, in the last month, 2 months, 3 months, kind of summarize what has brought us to where we are late in 2024 in the grain markets.
Yeah, I think the biggest thing to me, particularly if we kind of narrow our scope down to, say, corn and soybeans, by the time we got to mid-August, the real fundamental factors, the real fundamental reads on the U.S. corn market, they had been growing more bearish over time. But by the time we got to mid-August, everything started to change. And we started to see the spreads starting to cover less calculated full commercial carry. We saw commercials starting to do more buying. We saw basis starting to firm. And so this has been it's been an interesting evolution over the last number of number of months, that now we actually are looking at a bullish supply and demand situation for U.S. corn as 2024 gets ready to end. And when we can look at that all the way out through the 2025-26 spreads, and it's the same scenario. So that, is telling me we have seen strong demand. And as we look ahead to 2025 plantings, the markets again are saying we need more corn acres, more than soybeans. Will it change? Right now, it's not changing our fundamental read. So it's going to be interesting. Once we turn that calendar page to 2025, do the wheels fall off? Does everything blow up? Do we start over? That's the scenario that we've seen develop over the last number of months, and that's where we are as the year gets ready to come to an end.
Alan, what are your thoughts? Again, kind of bring us up to right now. What have been the major things that the market has had to chew on to get to where we are right now?
Well, again, we had, as he mentioned, we've got a record corn yield, record production for this past year. Now, we've benefited from South America having some weather problems on their half of the cycle, particularly their first crop corn a year ago. So that's what's helping us have the strong exports that we have coming into the fourth quarter here for corn. Soybeans are sort of front-end loaded on their exports, in that China's trying to get some in before there's any potential trade disruptions in 25. Bean market's a little more of a struggle here because we're looking at a much bigger carryover in stocks usage ratio, 470 million in the December WASDE, and we're looking at world soybean carryover stocks that are 20 million tons higher than we'd like to see them. So beans need to have the price cheap in order to stir up more consumption. Corn is trying to ration a little bit here, but as Darren alluded to, the soy-corn ratio for new crop has dropped down to 2.29, which is saying plant more corn next year and less beans. Mm-hmm. If we do too much of that, we're not going to like the corn market.
And maybe, Alan, to follow up on that, the structure of the market that we've seen right now, the values that the market is offering today versus carry to March, carry to May, carry to July, I don't remember in recent history, at least I feel like, that it's been this flat. What does that indicate?
Well, if you have full carry, which we're nowhere near, that's the market trying to allocate supply over time. It's saying we don't need all the bushels now, but we've got to reward somebody to keep them for later. When those board carries are smaller, the market's saying there's a better short-term demand scenario, and you need more of it to move up front. We're not at inverse market either. We still have a carry to March, but it does suggest that there's a little more demand right now. And this is the time of year when we should have more demand, or more consumption, more sales, because if you look at world supplies, this is our 6-month window. I talk about a 2-season marketing year. There's our 6 months to sell most of our North American production, then there's the South American 6 months. Yeah. So this is when we should be seeing the most interest in our commodities.
Yeah, and Darren, maybe would you comment on that too? Just what is at play right now? You know, with the carry and the basis, and it's kind of giving us the structure that we see late in the year.
Well, I knew it wouldn't take long for Alan to bring up the WASDE, so so I mean, there's that. As you know, I don't look at those numbers. They're make-believe. That's fine. I mean, if you want to say X number of billion bushels left over, or whatever yield was, it doesn't make any difference. But it comes back to what you're asking, Chad. And as I opened with, the change in these spreads has been interesting. Whether or not we actually had record production, nobody's ever going to know. I mean, let's be honest. We don't know what the yield was. Nobody knows what the total yield was. But we did see, again, up through early August, that the commercial side of the market, those who are actually involved with the underlying cash commodity, they were comfortable. So they were, as Alan said, they were putting pressure on the nearby in relation to the deferreds. But all that changed once we got into August. Is it a South American issue? Is it a U.S. issue? Again, I think we have, as Alan pointed out, we have seen a good deal of demand come into the market. Now, I'm not going to say that this isn't necessarily the case in corn, because I think it is. Who's the largest buyer of U.S. corn? Well, one of them is Mexico, and we know what that situation is going to happen. That thing's going to blow up here in a little bit. So Mexico's loading everything they can right now. The first 6 months of the marketing year does usually not focus on the corn, on U.S. corn. Soybeans are the biggest thing that move the first 6 months. Corn moved the second 6 months. This time around, corn's moving more, because one of our biggest importers, the importers of U.S. corn, doesn't like what it sees looking ahead. So as far as the spreads go, we know we've got strong demands chewing on supply. That's what the weakening carry in the spreads is telling us. That's what the strengthening basis is telling us, is that it's immediate demand. And again, we'll have to see how long this lasts. The difference, as Alan pointed out, is this is the scenario that we see in corn. It's not the same in soybeans. While the nearby future spreads are more bullish, again, because of short-term demand, further out, as we start looking out the May, July, and so on, when South American crops move center stage and the U.S. takes its customary secondary place on the global stage, that's where we see the biggest difference between corn and soybeans. It's just not that bullish out in beans.
All right. Let's talk about the 8,000-pound gorilla in the room, and that is the election in 2024. Because I think as we as Americans have a pretty short memory. I think that's a pretty fair statement. So I'm going to draw on your guys' historical perspectives. Darren, you were at DTN 8 years ago when then-elect Trump was ready to go into office. Is it the same as it was going into his first term, as the attention that's being given to that presidential election is this year?
I think so. I don't see any difference. The only difference is it's more heated now. 300% tariff, whatever it is, that's supposed to be coming on Mexico, increasing already tariffs that are already in place against China and who knows who all else. Probably, we'll probably get into another trade war with Canada and Japan and who knows. Everybody that buys from the United States is probably going to come under the gun, because they can at this point. That's just the way it is. There's no safety valve now for U.S. agriculture of a possible election 4 years down the road. That's gone. So the way I look at it, agriculture was, is, and really will be a pawn in the big game of chess, and pawns are expendable. And that's the view. That's the view coming from the president-elect, Washington in general, and so on. And we wrote about it at DTN back in 2016. I've been talking about it ever since. We had to take a step back. Isolationism never works. It just doesn't. Not when the rest of the world is working together. You can't set yourself out on an island and say, we're not going to deal with anybody. It makes it tough. So yes, I think the scenario is very similar to what we saw back in 2016, and probably going to be amplified this time around.
Okay. What are your thoughts about the election and the influence that has had on marketing grain?
Well, first of all, I have a little less pessimistic viewpoint of the upcoming situation than Darren does. I think quite a bit of this is negotiating leverage. They're talking points. You're trying to create red herrings, which you're creating something you can give that you pretend to care about and try and get something real in exchange for it. Okay, there's definitely going to be some trade war friction here. But I want to remind people that the supply doesn't leave the world, okay? World production is world production, world consumption is world consumption. What we're talking about mainly is when you get to ship your product and who gets stuck holding the hot potato. If you remember the children's game, you pass around the hot potato, you don't want to be the one holding it at the end. That's the ending stocks. Ending stocks are expensive to carry. You don't want to be the one carrying the ending stocks. So, China is less dependent on the U.S. for soybeans this time around because of the expansion of South American production. But the thing you also have to remember is that a lot of manufacturers have shifted their sourcing. They're not as dependent on China as they were in 2017. You got more supply out of Vietnam. You have more supply out of other places. Not so much grain, but for manufacturing goods. And the fact that the incoming president said we're going to enact all these tariffs doesn't mean that we know what the knock-on effects are. We don't know how China will react exactly. We know what they did last time, but we don't know if they'll do the same thing. Tariffs are a tax. They can be paid by the buyer or the seller. China's economy is very weak right now. They may, in fact, lower prices on some goods to offset the tariffs because they need the sales.
Sure. All right. We'll come back to that idea of what might happen, try and play out a few scenarios here in just a moment. But we really haven't talked about, I think, world events that have that have added to the condition that grain marketing is in right now. So, Alan, we'll start with you. What are some, years it was the Ukraine-Russia situation. Is that still a part of it? Is it weather in South America? What else is going on around the world that is having an impact on marketing grain?
Well, the big impact on the Russia-Ukraine situation is the numbers are no good. Darren and I go back and forth on how good USDA numbers are and whether you need them or not. We agree that the Russian-Ukraine exports and production numbers are no good because Russia's counting the annexed territories as part of their production, and that makes their production look bigger. But then they exported illegally under ships with no tracking devices on them. So those numbers are not good. Mm-hmm. Wheat market's very dependent on Russia, though. What they're willing to sell for, how much of an export tax they're willing to add on, how much they want to ration their supply in the following year. The other part of that is, of course, we have quite a few sanctions on Russia because of that activity over there. They've bypassed them. It's creating a problem in that they're getting some of the third world countries to ally with them in various degrees, whether it's Iran or China. They've attempted to expand the BRICS group of countries. There's been loose talk about it creating a currency to compete with the dollar. That isn't going to go anywhere. But yeah, does complicate trade for the U.S. because you're forcing some of these buyers that we depend on to pick sides.
Would you pick another world influence, Darren, if you would, and kind of expand on it? What else is going on around the world that is having an impact on our marketing of grain?
Yeah, I certainly will. I just want to add one thing to what Alan said. And the second thing that's going to happen, my guess is the second thing that's going to happen after inauguration is the sanctions will be lifted against Russia. That's going to happen. And so that changes that game a little bit. You mentioned, to me, when we look at the situation that we've put ourselves in, it puts a spotlight on the idea that production agriculture is, and it doesn't matter if we're talking about what crop we're talking about, it is a weather derivative. It is all dependent. It is majority dependent on what happens in weather. And we've seen this play out in the softs. We've seen skyrocketing coffee prices, cocoa, sugar, orange juice, all these things that are all tied to weather situations around the world, be it, as Alan mentioned, Vietnam or Brazil or the Ivory Coast for sugar, not for sugar, but for cocoa. So to me, as we go into 2025, knowing that we're going to be a secondary player on the export game, it's all going to be who has the supplies. Alan's right. Who has the supplies? And what's going to determine where those supplies are? It's not trade, it's not currencies. All that stuff doesn't make any difference. It's weather. If South America has weather, U.S. is out of the game. If South America has problems and they don't have the production, the U.S. is back into the game a little bit. And we're going to see this in all kinds of markets. We're going to, as I said, we've seen it play out time and time again in the softs. We're going to see it in the grains. Wheat, I don't hold out much hope for that. It didn't really get much of a bolster with this, Ukraine-Russia situation. The world just isn't interested in U.S. wheat. Russia was taking its grain, as Alan said. Alan laid it out perfectly, moving it around the world, taking Ukraine's grain, moving it around the world. So the wheat's basically just going to be what the wheat market is. Corn and soybeans is where, as usual, where the focus is going to be, and it's all going to come down to weather, whatever part of the world we're looking at.
Okay. We haven't talked about outside. You kind of alluded to it, the outside markets. Are there other things like the energies and energy policy, crude oil, renewable diesel, SAF, things like that? Are there other outside things that are at play here too? Darren, we'll start with you.
Yeah, I think so. We also know that the upcoming EPA is not ethanol friendly, so that's going to be interesting to see what happens there. It's more petroleum friendly. Now, the question becomes, okay, OPEC plus, which includes Russia. That's why I have to mention the OPEC plus, because Russia was a big part of what's going on. Are we going to see the production cuts come to an end? I can make the argument either way. From a global supply and demand point of view, there really isn't any need for OPEC plus to bring those production cuts to an end. Is it a possibility? Based on what's happened politically around the world, yes, it could happen. It could happen. We've seen this sorts of things before. If we look at energies, again, from a fundamental point of view, crude oil is still bullish. We still have, the future spreads are still telling us that it's a bullish supply and demand situation, but the market can't go anywhere. So it's an interesting play in the global energy markets. And other things, we're also looking at global stocks. So many people want to talk about global equities and these sorts of things. How long can this run last? I mean, the last 4 years have been big. We've seen stock markets do wonderful things. If all of a sudden everything comes unglued, not just in the U.S., but around the world in global stock markets, then what? Where does that money go? Where does it move to? And I think those are all things we're going to have to deal with.
What are your thoughts, Alan? And maybe we can include the financials in that too. The dollar, gold. We've had several record-setting days in the financials. So what else is in play?
Oh, don't forget Bitcoin 102,000 either.
Well, there you go.
Cryptocurrencies. Don't try that at home, folks.
No.
Well, Darren's already pawned off crypto. We know where that lies in him. But yeah, go ahead. Yeah. What are some of the other outside things?
I want to start with one of his themes, which is the stock market's been on a heck of a run here. Asset allocation suggests that you would start to back out of some of those positions to try and find undervalued assets to invest in. The question is, what are they? All right, real estate's still a little spendy here in the United States. Interest rates, I'll get to that in a second. But if you see a little asset allocation, a rolling of positions in the stock market, that frees up some cash. Commodities look cheap, but you don't really have the big inflation play, which is when the Wall Street folks would tend to put a lot more money into commodities. Having said that, I do see some hints of inflation here not going away. The market's still looking for the Fed to cut interest rates 0.25% in December and then kind of take a pause. Some of the recent CPI and PPI numbers would suggest they shouldn't even do the 0.25 point cut in December, that things are perking along a little too well. So what's that say? It means the interest rates, that the cuts that we think are coming down the road may be slower to happen. Interest rates may stay higher longer than we were thinking, say, in September. That has implications for storage costs for grain. Okay, it means selling, time value money, you maybe sell a little earlier just from that perspective. Going back to the inflation though, if the inflation runs a little higher than with the base case scenario, that's actually good for commodities. I'd throw out the dollar here. The dollar's been very strong since the election. That's a little complicated in that it doesn't help ag exports if it's strong, right? You'd prefer it to be weak. Now you look, who's it strong against? Well, one of the countries it's strong against is China. The yuan renminbi is bumping along 10-year lows against the dollar right now, and which means because they're trying to stimulate their exports, but that does make imports of U.S. goods more expensive for them. It does kind of favor them going to Brazil and other third-party countries.
Well, very good. So I think we've talked enough about the past and kind of where we're at right now, late in the season in 2024. Let's turn our attention, gentlemen, and look forward now. And kind of what I want to do with this is I'd like you to each in your mind kind of think about as we get into 2025, we're looking to market grain, and we can talk old crop or new crop. But what's a best case scenario that you see playing out? What is the worst case scenario that could happen? And then I'm going to ask you guys to pick one of those and defend which do you think is actually going to happen. So, Darren, I think we'll start with you. Give me, what is your best case? What could happen that would be positive for marketing grain in 2025?
Okay, so you're asking the person who has a reputation for being the most pessimistic analyst in the business, what is the best case scenario?
Yep.
Maybe that we actually are all around to see New Year's Eve 2025. That might be the best case scenario. But in all seriousness, it's what I mentioned earlier. Let's say that El Nino really intensifies across South America, and particularly Brazil, and it just decimates the crops. And despite the self-imposed tax the U.S. is getting ready to face by way of tariffs and trade wars, which raises domestic prices, not foreign prices, if we can get through that, and if some of the world's buyers are forced to come to the U.S. door, that's the best case scenario. So the best case scenario for U.S. agriculture is to have a disaster somewhere, anywhere, everywhere in the world. Because otherwise, then we're looking at the worst case scenario. Nobody wants U.S. grain. And we know how to produce grain. We can produce corn, we can produce soybeans, we know we can produce wheat. But if nobody's interested in it, all of a sudden, that creates a problem. So the best case scenario is devastating weather around the world.
Yep. What's in your mind? What are the elements of a best case for marketing grain out of the United States for the Nebraska and surrounding area producer?
Well, first thing to remember is that prices do move around. Okay, the average trading range in soybeans since 1980 has been just around $3 a bushel in a marketing year. So far, we've done a little over $1. On corn, the average range is $1.52. We haven't seen that extent of volatility yet. So there's room to the upside on both of these markets just due to normal price variability. Best case scenario on the current marketing year for beans, which is now through next August, if you just have that average move, you'd touch $11 on the high. Now, I'm having trouble coming up with a scenario to do that when we've got this big a carryover. It may not be an average price range year, but the bullish scenario on beans would be some kind of South American problem because they're the major exporter. They're bigger than us now. On the corn side, I think stocks are tightening. Ending stocks are tighter than a year ago. Yeah, we can argue about the WASDE numbers, but we do know that if stocks are tightening year over year, most of the funds don't want to go short. All right, particularly the more traditional, well-established commodity funds, they're adding longs when stocks are tightening. They're adding shorts when stocks are getting looser. Yeah, so the bear scenario is we have a big acreage in corn this year, and we get a good yield again, and the world doesn't really want that extra production. I don't want to look past the biofuels though. Darren referred to the EPA as maybe not being friendly in the new administration.
I think we both know it's not.
But I want to think about just the EV versus conventional fuels argument. Okay, if you just back off the EV stimulus, that's friendly for conventional fuels, which by definition includes the blended renewable diesel and the E15. All right, it may help us sell more of those products just because you're not pushing everybody to EVs.
My thanks to Chad, Darren, and Alan for their time and expertise, and a special thanks to you all at home watching this week's edition of Market Journal. We're grateful to have be a small part of your holidays. Until next time, I'm Bryce Tuskett, wishing you a Happy New Year.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.